tax generally is a domestic concept to discuss the tax imposed on businesses and the separate layer of tax imposed on individuals. The most simplistic way to describe this would be a corporation, a C Corp, which has customers and earns $100 of revenue. That $100 of revenue is subject to corporate rate now, which is 21%. Prior to 2018, it was a maximum of 35. Now it's a flat 21. So when the corporation earns $100, it pays $21 to the IRS. Now here's where the second layer of tax comes in, as these corps are typically owned by shareholders. If the shareholder is an individual, when that corporation makes a dividend, and now it only has $79 to distribute up after paying taxes, that $79 dividend is subject to a second layer of tax. Now, in the U.S., the highest individual rate is 37%. However, qualified dividends, which we're going to assume this dividend coming from a wholly owned C Corp, should receive preferential rates of 20%. So the $79 is taxed at 20%, which equals 15.8. So overall, between the first layer of tax, corporate layer of tax at 21, and the second layer of individual tax at 15.8, we have 36.8 overall taxes paid on $100. That's a 36.8 effective tax rate, and that's what we mean by two layers of taxation. Notice in our example in the video, we did not take into account the 3.8% net investment income tax. This is an additional 3.8% that applies on passive income, such as the dividends coming up from US Corp.